Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. This video is one of my favorite videos to do because we're going to talk about everything to do with dividends. 10 different companies that are dividend growth companies for 2025. Now, hopefully in the next few weeks we might see, or months, we might see a correction. We might not even see it, see what happens. But if we do see a correction is normally 10% or higher, the stock market going down 10 or more. Okay, so if that happens, it will give us long-term as long-term investors, it will give us an opportunity to buy high quality businesses for a below their intrinsic values. Why? Because some people just sell it because they get scared, because they don't think about this is actual business. Like if, for example, the market goes down 20% today, Apple still sells iPhones that cost thousands of pounds, and they still selling it everywhere around the world. The business still intact. Because the stock market went down because some guy decided to sell, that doesn't mean the business is basically running out of business or something, right? So a lot of people don't understand. They see the stock market going down, they start selling, and that is a great opportunity for us as long-term investors. So what I'm going to do is I'm going to talk about 10 different companies that are dividend growth companies. These companies have a wide economic moat. That means they've got they can fed off the competition, if you like. They can, in terms of market wise, they kind of monopolize the market. They're the leader in that market, sort of thing. Okay, and if you haven't seen my video, the last video, just go and watch that, because that will kind of give you my understanding of why dividend growth companies are very important. And you will be very surprised. So I've taken all the 10 companies and put it into, I kind of back tested over the last 20 years, and you'll be very much surprised to see the returns from these 10 companies. Okay, so let's get started the video. I don't want to make it any longer than it needs to be. If you have not joined us at the Patreon account, please do so. It genuinely helps the channel. You get access to the Discord, you get access to the family portfolio, which I don't share here. You've got the basically high quality stocks that I share with you guys monthly. I've got the undervalued stocks, which I've updated yesterday or day before. Sharia compliant investing ebook, which is there, that kind of 10 something pages that kind of shows you what to do, what not to do to invest in the stock market and so you got a lot out of it, inshallah, including the watch lists and so on. So go and watch that, please. Go and get that, inshallah, if you can, and that will be massive help. Now let's talk about these 10 different companies that are dividend growth companies that have been around for a very long time. Two things I've highlighted here are the moat. Okay, so do they have a moat around their business? And if they do, then that means it's good. Okay, now the 5-year growth rate also tells us what the companies have done over the last 5 years, and if they continue doing similar sort of a thing, we are in a good position. Let's now look at the first company, and that is Mastercard. Mastercard has been around for quite some time. It is a Sharia compliant company because they don't basically deal with the river side of it. They facilitate for those transactions. They're more or less a technology company, so they the tech company rather than a financial company. Okay, 482 billion market cap, wide economic moat, 521 per share right now in terms of price wise. Dividend yield 0.58. Some of the companies that you're going to see today are not trading based, they don't have like 10% dividend yield or whatever. We're not looking for that. We're looking for the growth, we're not looking for the yield side of it. So we're not chasing yield, if you like. The payout ratio is 19%. The latest increase, this is important, by the way, because this tells us that the company has room to increase that dividend. So they're only spending 20% or 19% of their net income to pay that dividend. Some companies will have 80-90%, so that means they're spending 90% of their basic net income to pay us. What's the point of that? You might as well cut it and then grow the business. How are you going to grow the business if that's the case? And I do own one company that are basically getting closer to that, what I just said. So the latest increase was 15%, which is absolutely huge, and the 5-year growth rate was 17%. 12 years of increase in that dividend, you got $3, over $3 for as annually, and safety is 99%. So that means it is safe. Okay. Then the rest is absolutely self-explanatory. Profit margin, return equity, return invested capital. There's not that many companies out there who are very similar to this business. $12.8 billion of free cash flow. You would have made 20% per annum if you own this company for the last 10 years in terms of total return. and they're expecting double-digit growth, but right now it's slightly expensive. Okay. The next one is Waste Management, another company that has a dividend growth, so 9% in the last 5 years. They have a wide economic moat. They've got payout ratio right now is only 41%, which is fine. You got that 1.6. At one point, this company was about 1. Now it's actually coming back and becoming a bit more cheaper. So if it comes back down to at least another 10-15%, I will be adding more because I do own the company in my portfolio. Latest increase was actually 10%, which is absolutely amazing. 20 years. So this means now 5 more years they will become a dividend aristocrat. Now the payout ratio, the annual payout is very good. The dividend safety is 80%. Profit margin, return equity, return invested capital, really, really good. $2 billion of free cash flow right now. Total return the last 10 years, 16%. Company that sells, basically that deals with garbage and all of that stuff. Basically having this type of growth for the next whatever, basically for the last 10 years, and expect it to grow double digits. It's absolutely amazing. That's why I really like the business. I like the dividend side of it. I like the free cash flow. I like the growth side of it. I like the margins. So I like everything about it apart from valuation. And the valuations, I am a little bit comfortable buying here and there, but I don't have a full position yet. And so yeah, but I want this to become 5% of my entire portfolio. We're not there yet. We're probably less than 1%. Next one is one that has actually, I've got full position right now. That's Broadcom, $1.1 trillion company, wide moat. The payout ratio 45% only. The latest increase was 11%. The 5-year growth rate 14 years of increase in that dividend, and annually you get $2.36. 67%, 61 and above is safe. Okay, so it's absolutely safe. Return on equity, profit margin, return on invested capital, all up them, not the best out there, but it is decent. Almost $20 billion of free cash flow. Total return the last 10 years, 38%. This is a company that grew over 100-something%. I can't remember what it was now this year alone because of all the madness about AI. 30%. They're expecting the earnings to grow about 30%, revenue to grow about 19%. Basically 24% right now premium. 190 is where they think the price should be. The next one we're looking at is another one that I own in the portfolio, and that's Merck. 249 billion market cap, wide moat, over 3.29% dividend yield, which is really good. Okay, the payout ratio we're looking at about 51%. The latest increase was 5% and 9% again. So not double digits, but 9% for the last 5 years, which is really good. That's basically what you try to do here is basically inflation beating growth. And your entire portfolio will then become that. You know what I mean? And that means if you invest in this type of businesses, you're beating inflation basically. Rather than your money sitting in the bank, your money is actually beating inflation, and you still have some return, which is really good. 12 years of increasing that dividend, 3.2% when it comes to annually. Dividend safety of 90%. Profit margin, return equity, return invested capital, really good. $14.8 billion of free cash flow, which is absolutely huge. 8% when it comes to total return in the last 10 years. EPS 23% expected to grow. Revenue 5%, 18% discounted right now. $120 per share is where they think the price should be. Right now it's about 100. The next one is Visa, very similar to MasterCard business-wise. Both of them do not deal with anything to do with Triacom, anything to do with the river side of things. Huge company, 616 billion market cap. Now, the payout ratio is only 21%, which is really good. But the dividend starting point is not basically the best, but it will increase for the next 5, 10, 15 years and so on. Because the last 5 years, they've done about 15%, which is good. 13% in the latest increase. 16 years of increase in that. 9 more years, they will become a dividend aristocrat. Annually, you get $2.36, 99% safety. This side of things, profit margin, return to return invested capital, really the best. $18.6 billion of free cash flow, 17% total return in the last 10 years. EPS, they're expecting to grow about 13%. Revenue, 10%. Fairly value right now, $289 per share is where they think the price should be. Next one is the one that I used to own, and I wish I kept this company. KLA Corporation, and one of the semiconductor companies out there, manufacturer side of things. And as you can see, equipment side of things, 85 billion market cap, wide moat, and the dividend payout ratio is only 23%, which is absolutely amazing. Can you imagine 17% increase, the latest one, 13 basically for the last 5 years, 14 years of increase in that dividend. You get $6.80 for every share of this company that you own. Safety 71%. Profit margin, return on equity, return on invested capital, by far one of the best companies out there. Over $3 billion of free cash flow. And I like the fact that 25% total return in the last 10 years, 7% in terms of expected the EPS to grow 7%. Revenue similar, fairly value right now, $670 per share is basically where they think the price should be, which is right now 656. Okay, so not far off. So it's still fairly valued. If it comes back down quite a few more, I don't know, 5% more, whatever, it might be become a little bit more attractive. I might be still looking at it again. Now the next one is Home Depot, another one that I have in the portfolio. Absolutely amazing company, 60% the payout ratio, so it's getting to that safe kind of unsafe territory. So hopefully they will start reducing that rather than going it up. 2.3 is what you get. Latest increase was 7.7, so almost 8%. 14% in the last 5 years, 15 years of increase in that. $9 is what you get. 87% safety, which is absolutely amazing. Again, this side of things, absolutely nothing to worry about. Free cash flow of $16 billion. Total return, we're looking at about 16% in the last 10 years. And then revenue and EPS, they're expecting about 4% each, and 33% premium right now. $292 per share is where they think the price should be. The next one is Procter & Gamble. Again, another one that I own in my portfolio. I genuinely did a lot of research, and the best companies out there was the ones that I was looking for, companies basically that are growing the dividend 6% or higher, and these were the companies that came up. Normally, that's why I've always said to you, I want a 6% or higher. So some 7% will probably be better, but 6% is not bad at all. 58% when it comes to the payout ratio. 68 years of increase in that dividend, which is absolutely crazy. Look at the safety, 99%. Look at the cash flow basically they have right now, free cash flow of $15.8 billion, right? Look at, check this out, 16, 17%, 28%, 22%, absolutely nothing to worry about. Total return the last 10 years, we're looking at about 8% and 7% in terms of EPS growth, expected to be about 7%, 4% when it comes to the revenue side of it. A little bit expensive, about 16% right now, premium, 143 is where they think the price should be. If we see basically a 10% to or more decline in the S&P 500, and this company does the similar thing, it's slightly more defensive, to be honest with you, but if it comes down maybe 10% or more, I will definitely be buying more, because I haven't bought one single share of this business for over 2 years, I think now. Next one is S&P Global, a dividend king. The payout ratio is very low. The dividend yield is not great. The latest increase was only 1.1, but 12% in the last 5 years, which is amazing. In terms of safety, 99%, return on equity, return on invested capital, and profit margins, all of that absolutely fine. In $5.1 billion of free cash flow right now, 19% in terms of total return in the last 10 years. They expected the earnings to grow about 10%, revenue 7%, fairly value right now, $480 per share is where they think the price should be. And finally, no this. Basically, this is one of the companies that have basically came down a lot recently. Probably one of the best out there when it comes to pharmaceutical companies because of the weight loss drugs and so on. Eli Lilly is expensive right now, so this is the next best thing if you like. I'm currently looking at it thinking potentially I might add into the portfolio. I don't think they're in the S&P 500 actually, so I can't say it's a dividend aristocrat, because one of the requirements for a company to become a dividend aristocrat is they have to be part of the S&P 500. Nevertheless, 1.6 when it comes to dividend yield, 48% when it comes to the payout ratio, 52% the latest increase, 18% when it comes to the last 5 years, and safety 99%, profit margin, return on invested capital, probably one of the best out there. And I like the fact that basically they've got excellent free cash flow. The total return the last 10 years is great. They expected the earnings grow really massively, fairly valued right now. $86 per share is basically where they think the price should be right now. It's 87. So I'm currently doing a bit more digging about this company because of the growth side of it, because of the dividend growth side of things, and I like the free cash flow. So I'm going to do a little bit more research. If I add it to the portfolio, I'll let you know, because right now I don't have that many companies that are pharmaceutical companies right now. I've sold a few. I've sold J&J, I've sold Medtronic. Both companies are great. Medtronic hasn't done anything in terms of growth side of things over the last 10 years. J&J, because of the lawsuit that was going on, I had to sell it. J&J, I've always said, is probably wouldn't have made this list if I still owned it, because The reason why I don't want to basically share J&J right now is because of that risk that's still ongoing. So once that lawsuit situation basically settles, and I don't think the company will have any issues because their credit rating is like AAA. It's higher than the US government. Basically, they got better credit ratings. Okay, but I didn't like that. If that situation is out the window and the price stays a similar sort of thing where it is right now, I'll be buying back J&J tomorrow, because that is basically sleep well at night kind of stock. But generally hasn't done a lot over the last 5 years as well. But now because of this spin-off, probably will do well. Anyway, this is something a company that I'm looking at right now. Now, 2 more things before I show you the most exciting part of the video. Let me show you the Sharia compliance side of things. You can pause the video and have a look at that. But let me show you the most exciting part about these things. Imagine 20 years ago, you bought all 10 companies and you put basically £1,000 every single month, reinvested the dividends every single month for 20 years. Okay, because that's what we say. That's what I'm preaching every single day. I'm saying to people, do this. For 5 years, I've had similar sort of a basically mindset. 20 years, investing $10,000 in beginning. We're contributing every single month £1,000 or dollars, whichever. Okay, inflation adjusted. Dividend reinvested. Each company gets equal amount, 10%. So we have a portfolio of just this. I'm not saying go away and do this, by the way, because the past does not tell us what's going to happen in the future, but it just gives us an indication of where it might be heading. So 100% entire portfolio, right? We click this, okay, and guess what? We invested 10,000. We invested 1,000. Okay, just remember that 1,000 every single month for 20 years. So imagine you got the same, basically you've been working for the same company for 20 years or whatever it is. Your salary is, let's say, 3,000 plus £5,000 or dollars, whatever it is. You can afford 1,000. You just put that 1,000 away every single month from 2004 to 2024. Okay, monthly 10,000 starting point. Reinvested the dividend. Right, this is where you would be right now. $2.3 million, which is absolutely ridiculous. And this is why I love the stock market. Okay, and yes, we're back testing. This can easily change. We might even have time where basically have the lost decades and all of those kind of things, right? But generally, that's basically what you expected. Now, let me show you one thing. This is why basically dividend growth companies and reinvesting your dividend is very important. If we say we're not reinvesting that dividend, okay, we're taking the cash. Let's rerun this. Let's see if it works. If we take the cash, will be 1.8 from 2.3 million to right now 1.8 million. So it's not actually huge, but at least it helps. It helps to reinvest that dividend, and it helps basically that you're making constant contribution to your portfolio. Because if we said none, okay, we invested, basically 10,000, we're going to reinvest our dividend every single month, however we get it, we will only have $350,000 in comparison to the compounding will take place if you decide to contribute monthly this much. Okay, you will be making way more money. 2.3 million. It's 2 million more. Okay, because you're basically adding £1,000 every single month. So this is why you need to be consistent. This is what I've been trying to do. That's why I'm trying to be consistent and add similar sort of money every single month, more or less, and try to max my ISA account, which I don't know if I'm going to end up doing this year, but I've got £14,000 to invest. But InshaAllah, I will. I'm going to give it a go. Don't you worry about that. Normally, the 2 months leading up to the April, that's basically when I add a lot of money. So InshaAllah, we will see. I'll let you guys know. I'll keep you updated. I'll keep you informed as much as I can, InshaAllah. I hope you're enjoying this content. Genuinely, if you are, it takes a lot of time and effort to put these videos. First of all, to plan it. First, then record it. And then, of course, use all these subscriptions and all of that. And then edit it and then send it to your way. Takes a lot of time. Genuinely takes a lot of time. I have a full-time job, and 2 children, so it takes a lot of my time. But I would genuinely appreciate if you can just go on the Discord, if you can join on the Patreon account, where you get access to a lot of these things, and you get access to the Discord, which have like loads of brothers and sisters who are sharing good practices. Anyway, I'm going to stop here. Have a wonderful day. Assalamu Alaikum.